Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hey, welcome everybody to another SED Zoom call. Today we've got companies called PUDO Incorporated. We have with us CEO Elliott Etheredge. PUDO trades on the CSE under the symbol PUDO, and under the OTCQB with the symbol PDPTF. The stock last traded at 35 cents. Company has roughly 33 million shares outstanding, so roughly call it a $11.5 million market cap. Elliott, great to have you here. Appreciate the time. This is a company that I know certain Trevor's been following for quite a while, and I think we were sort of introduced probably about 6 months or so ago. So love to hear what PUDO's all about. You got your presentation all set up, so I'm just going to hand it over to you.
Great. Thank you, Paul and Trevor. Thank you all very much for setting this up. It's great to be with everybody today. I realize that perhaps for many of you, I am the last thing standing between you and a long weekend, so I appreciate your time. Just to clarify real quick, so our Canadian ticker is PDO. There's three letters, PDO, and then as Paul mentioned, on the OTCQB, we are PDPTF. So just real quick, obviously we've got the forward-looking statements and disclaimer. So this is something y'all are well familiar with, but obviously something our attorneys are required to include in here. So please pay attention to that. PUDO is an acronym for pick up and drop off. And we exist to address the last mile pickup and delivery challenges of e-commerce. As many of you are likely aware, getting packages to someone's doorstep or from someone's doorstep is very expensive. And we have developed through a network of what we call PUDO points, a company and a network that facilitates dropping off packages and picking packages up by e-commerce shoppers. So a shopper who is looking to process an e-commerce return would go onto a retailer's website, and they can select one of our PUDO point locations to have to drop off their package. We then have a logistics infrastructure behind that goes and collects the packages, brings them to a sorting facility where they're processed, sorted, consolidated, and then sent along based on the business rules that the retailer has. Similarly, shoppers can use the PUDO points as a pickup location. So instead of having a package delivered to their doorstep, they may opt to have a package delivered to one of our PUDO points, where they will then go and pick up the package in lieu of having it delivered to their home. There are a variety of reasons that people do that. One is security. If you're in apartments or in an area that or maybe you're out of town and you don't want to, have your packages sitting on your doorstep. Another thing that we're increasingly finding, and we'll talk a little bit more about this as we go through the presentation, is that retailers are starting to incentivize shoppers to choose this option instead of having it delivered to their doorstep to eliminate cost. So delivering a package to a shopper's doorstep is very expensive. And we're starting to see a lot of retailers that are offering shoppers, say, a discounted price or a coupon or some kind of incentive to say, look, instead of us delivering this to your doorstep, we'll give you an incentive for you to go pick it up. PUDO started in Canada in 2015. Our network in Canada is very comprehensive, and right now we're currently very aggressively expanding in the United States. So here's a map of our current PUDO point network. We have about 800 PUDO points in the US and in Canada. These PUDO points are typically independent retailers. So you're talking about convenience stores, parcel stores, dry cleaners, drug stores. And our PUDO points, we pay them a fee, a per package handling fee. But what they also really like is the foot traffic. So we're bringing shoppers into their store. Also in Canada, we have a partnership with Staples where we are active in all 300-ish of Staples locations in Canada. And this has been a very good partnership both for us and for Staples. And if next time you're going to Staples, if you're going by Staples, I encourage you to go in there, check it out. I think you will be amazed at the amount of packages that are flowing through this network. Quickly, and I'm sorry to do this, everybody. We're on a February year end. It drives me nuts. So I'm just going to have to orient everybody to that. So these are our fiscal year end 2025 results, which we can just think of it as calendar 2024 because we're on the February, but it's a February year end. As you'll see, our annual revenue from fiscal 24 to 25 increased about 27%. From just over $3 million to right above $4 million in 2025. And you'll also notice that for 2025, our cash income is positive. One of the things I want to point out is that our quarterly revenue, you'll notice a very significant jump in the fourth quarter of 2025 in both revenue and income. And that is the result of a lot of efforts that we've had underway in onboarding, in particular, a new customer, increasing share of wallet with increasing customers, the expansion of our PUDO network in the United States. And a lot of that just kind of coalesced in our fourth quarter of 2025. And so you're seeing a really nice pop in the revenue growth there. I'm also going to mention that all these numbers are in Canadian dollars. So keep that in mind as well. I talked a little bit about our service offerings. This will give you, we're going to go into a little bit of a deeper dive on what it is that we do and how that contributes to the business mix. First and foremost, our customers use us because we provide a cost-effective alternative to all the big guys. UPS, FedEx, Purolator, Canpar. And in a lot of cases, we're actually less expensive. In many cases, we can be up to 30% less expensive than your bigger carriers. And we do this by designing bespoke solutions for our customers. So our process is often fine-tuned to meet the specific logistics requirements of our customers, and that enables us to reduce cost. Whereas often when you're dealing with the bigger carriers, you're buying into their network, you kind of have to take what you get, and then you get a price, obviously, that coincides with that. Specifically in our revenue mix, returns is the biggest portion of our business. It's about 52% of our revenue, and it's also the fastest growing segment of our business. As you'll see, the volume growth in fiscal 2025 was up 150% for the returns business. Again, shopper purchases something online, they go to the retailer's website to effect the return. The shopper is shown a PUDO point as a location for drop-off. The shopper will either use a QR code on their phone or they'll print a PUDO branded label for that return, and then they'll deliver it to their local PUDO point. We have another service. Our second biggest service is what we call for pickup. And that is where we work as an intake function for the large carriers. So again, for your UPSs, FedExes, Purolators, Canpars, where shoppers will drop a package for those couriers to then be inducted into their system for further shipment. So that's about 50% of our business, excuse me, about 18% of our business, and we saw about a 50% growth rate in that last year. We also service couriers as a failed first attempt alternative. So if a courier is going to deliver a package to a shopper or to a consignee and the consignee is not available to receive the package, they will, instead of attempting another delivery, they will deliver that package to the local PUDO point. The shopper will be notified that the package is available for pickup at that PUDO point, and then the shopper comes and picks it up. So this is saving the couriers a lot of money in trying to perform repeated attempts and intersecting with a consignee at their doorstep. In our third-party logistics business, we provide rate management and logistics consulting services. This is about 10% of our revenue. It's about a 17% growth rate. Our direct to PUDO business is where shoppers can use our PUDO points as their delivery address, as I mentioned before. That's about 6% of the business, and that has been kind of a declining business, but it's so small, it's kind of, the numbers fluctuate pretty easily. And then Connect is a business where Canadian shoppers pick up packages at PUDO points in the United States. So PUDO points along the border, Canadian shoppers will make purchases for things that they can't otherwise get in the United States, or they can get it in the United States at a better cost. The Canadian shopper will cross the border, they will pick it up from one of the PUDO points and then take it back home. And that's about 4% of our revenue. So you can see really the bulk of what is driving our business right now is the returns business, and that is largely where we are focused. Our customer mix, we bifurcate our customers between direct customers and indirect customers. So our direct customers are retailers, SaaS providers, couriers, and 3PL companies. Indirect companies would be companies whose products we service on behalf of our customers. So it may be easier to think about, say, Purolator as a customer of ours. If Purolator has, say, Speedo as a customer, and we are handling their merchandise through our network on behalf of Purolator, then Speedo would be an indirect customer, where Purolator would be our direct customer. But you can see here, with our direct relationships, we work with some of the largest retailers and SaaS providers and 3PLs, really in operating in the world. So Inotex may or may not be a name that you're familiar with. You're probably more familiar with their brand Zara. They have a number of brands. Inotex is one of the largest fast fashion retailers in the world. Amazon, clearly people are familiar with Amazon. We work as a part of the Amazon Hub network for customers to pick up packages. Stables, we talked about. Wish. Indirectly, we have SaaS providers like Zigzag and Rebound. If you're not familiar with that concept, basically what it is the SaaS providers are providing a logistics software solution to retailers to help manage their last mile delivery. And the SaaS providers typically don't have trucks. They typically don't have the ability to actually move packages. So they partner with people like us to become part of their solution. So Zigzag and Rebound are two of the largest. And often what will happen is if Zigzag is competing for, say, a global RFQ for a large retailer, we will be included as the Canadian solution or the US solution as part of that RFQ. Again, the contract that we have is with Zigzag. Zigzag has the contract with the retailer, but then we start servicing the retailer's packages. As you can see down below, our customer mix, we do have some significant revenue mix with our customers. It's been getting more diluted, obviously, as we're growing, but our biggest customer is about 33% of our business. Our second biggest customer is about 20%. Third is 15, 11, 7, and then all our others are about 14%. Our network, as I mentioned, is one of the big drivers for growth for us. And the Canadian network today, we consider to be very robust, significant coverage. In Canada, we look at network expansion as kind of trading up and top grading locations. We don't really feel like we need to add a whole lot more locations in Canada to serve the Canadian market. The US is where we're heavily focused on expanding the footprint. So you can see last year, our PUDO point network grew by about 11%. And this year, as I said, we expect that to grow quite a bit faster. Our package volume grew by about 40% last year, as to what's going through that network, up from 1.2 million packages to about 1.7 million packages. In March, we did an offering, and there were two significant components to that offering. Part of it was a equity for debt settlement. We really didn't have debt. It was really equity for accounts payable. So the company over the last several years has been trying to refoot itself and get refocused on the mission. And I joined the company about 2.5 years ago. And since then, we've been very focused on trying to solidify the operations of the business, solidify the market presence, solidify the IT, and solidify the balance sheet. Fortunately, during that period, when we did have some cash flow challenges, a lot of our vendors were willing to float payments for us and to give us time. And as part of the settlement, as part of the offering that we had in March, we settled a good chunk of those liabilities where we exchanged those liabilities for shares. We also brought in some cash, which was very helpful for the balance sheet. And you can see today, or I guess at year end, where we ended up in 2025, we had about $750,000 in cash. We had about $600,000 in AR, $120 in prepaid and prepaids. So current assets of about $1.5 million, liabilities about $770 million. So our working capital positive about $730,000, significantly better than where we were in 2024. And again, and as I said, no long-term debt whatsoever on the business. And then a quick ratio, obviously, we've got it here in the graph, that is significantly stronger in 2025 than it was in 2024. Looking into 2026, and again, this is really calendar 2025, the biggest drivers that we have to push revenue forward is network expansion. We're going to be looking to launch our return service into approximately 5 major US markets this year. In the United States, as I mentioned, we have about 850 locations. Those all provide and support the pickup service. We currently only offer the returns service in 4 markets: Boston, New York, New Jersey, and Miami. We're going to be looking to expand to 5 additional major US markets, the return service. And then commensurate with that, we will continue to expand the pickup options in those markets. We're doing this by hopefully we're targeting partnering with large retailers or large franchise operators where we can bring significant number of locations into the network on a rapid basis. And then, as I said, we're looking to expand the Canadian footprint opportunistically. Increasing share of wallet. We have fortunately seen very good support from our existing customers. As an example, one of our significant customers in Canada When we first started working with them, we were only handling about 30% of their returns business. Today, we are handling about 60% of their returns business. So we are looking to increase share of wallet, not only in the amount of volume that they're currently providing, but we're also talking to our existing customers about adding more of our services to them. So I mentioned where a lot of retailers are looking to incentivize shoppers to go and pick up their packages. We're having conversations with retailers to use our PUDO points, our existing retail customers to use our PUDO points to affect that service as well. And the new customers. So we are constantly looking to add retailers directly, partnering with new 3PLs, and also with SaaS providers. We look to align our offerings with theirs. Again, when we go to approach people, we're doing it on more of a bespoke basis. So our sales pitch is usually highly tailored to meet the core demographic of their customer or their shopper. So adding new customers is our third big pillar for growth in 2026. So with that, I will open it up to Q&A.
Perfect. Thank you so much, Elliott. Yeah, just a reminder that if you got a question for Elliott, please use the chat function and we'll ask the question. First thought that came to mind, you mentioned literally hundreds of PUDO points across both Canada and the US. What's the cost to sort of light up a PUDO point in one of these facilities?
The cost is really in recruiting the PUDO point, and that varies. We will have PUDO points that will come to us because they have heard of the network or just through our general branding and general, kind of marketing that we do to that ecosystem. And then there are areas where, like Boston in particular, is a challenging place to locate PUDO points. So we have more of a targeted effort to recruit PUDO points. So on average, I would say our cost to recruit a PUDO point is somewhere around $200 to $400. It's not very much at all. And then as far as onboarding goes, onboarding is very simple. It takes about 20 minutes to onboard a new PUDO point. The IT that is deployed to offer this service is available either through an app. So most of our stores will use our PUDO app on a handheld device to perform the services. So our stores don't have to invest in any IT. We don't provide any hardware to locations to be able to get them up and running. We can also integrate with the point of sale system if they would prefer to do that. But most of our locations, because they are not necessarily parcel stores, typically opt to use the handheld device to perform the service. So as far as recruiting and building out the network, as I said, it's a pretty cost-effective way for us to do it. And we can get people up and running very quickly.
Now, Elliott, while I look at this map, you're geographically, it seems like you're covering a lot of space, but I got to believe you're not even close to tapping into sort of the real size of this market. Can you give us a sense of what expansion you think there's available to you, kind of what the addressable market might be? I have no clue in terms of how big this operation could be.
Well, what I'll say is this. 25% of everything purchased online gets returned.
Wow.
So it's big. It is staggeringly big. And as far as how that market gets priced out, today a retailer is spending on average about $15 to $20 per return to get their merchandise back. So 25% of the e-commerce market being returned, average cost of $15 to $20 to the retailer. That's not what we charge. What we charge is a fraction of that, but that $15 to $20 is including their entire process. So getting it back from the shopper, getting it back into their logistics infrastructure, inspecting it if that's what they're doing, repackaging, and then restocking or whatever their process may be. But it is a very, very large market.
It sounds like it. And as far as your ability to expand, I guess what's the pinch point as far as expansion for you guys?
The pinch point is building out the network and adding new customers. But really, the challenge that we have in expanding in the United States in the returns business is building out a critical mass in the United States. So standing up and operating a PUDO point as a pickup location, that really doesn't cost us very much. Packages are sent by third parties, not by us, into those PUDO points, and then we pay the PUDO point a per package fee for handling that. We don't have a logistics infrastructure behind the pickup side of the business. Where our logistics infrastructure comes into play is supporting the returns business. And there we have to have a critical mass of PUDO points to accumulate sufficient volume to justify deploying the trucks and the sorting services and all the logistics that go into affecting the collection of the package from a PUDO point and getting it back to the retailer. So what we do is we target specific markets and we say, okay, let's look at Los Angeles. We have volume data from our customers and we know where that returns volume resides. So one of the things that we've gotten a lot more aggressive on this year is a lot more sales and recruiting effort where we take that volume data, we identify those zip codes, and we say, okay, we need to go recruit PUDO points in these locations. And once we have critical mass, we'll activate that for returns function. And we need that to be able to then recruit more retailers in the United States. So we have a great product in Canada. Like I said, our Canadian footprint is very well developed. We have no issues going and marketing to new retailers or 3PLs or anything like that in the Canadian market, because of the density of the network that we have there and the robustness of the market that we have in Canada. But we need a better footprint in the United States to be able to do that. And fortunately, we have what I would call anchor customers that we work with in Canada that really want us to do this for them in the United States. So it's not completely, if you build it, they will come. We are being pushed by a lot of our customers to do this. And so I think that's a very fortunate situation for us to be in.
And I mean, maybe you partially answered this question, but then it comes to the retailer. How do you go and convince a retailer that to effectively trust you to handle this portion of the business?
Yeah, that's a great question. It is becoming a lot easier. And again, it's a situation where our reputation is starting to evolve, where we're starting to get, increasing inbound requests where people are asking us to help them. We still do work a lot with the SaaS providers to bring those retailers, sometimes to bring those retailers into the mix. And again, sometimes it's because Canada in particular is only part of a global solution that they're looking to service. And so it makes a lot more sense for us to come in through the SaaS provider. But again, reputation in the marketplace has enhanced the conversations that we have with those SaaS providers. And then the same comment for 3PLs. Like one of our larger customer additions last year was a 3PL in Canada that is servicing Temu and Shein. So again, we don't service Temu and Shein directly. They do, but if anybody has been on the internet at all lately, you've heard Temu and Shein. And that's been a very nice addition to our volume.
Yeah. Awesome. Maybe let's break down some of the economics here. So a retailer pays you. It sounds like on a per package price. But what's the breakdown? What do you guys get? What do you guys pay out to your PUDO points and other pieces? Like what kind of margins do you get in this whole process?
So the business today operates on about a 35% gross margin. And that is across all services. The margins on the returns business are less than that, and the margins on the for pickup business is higher than that. The per package fees range significantly depending on whether or not there's a logistics component as part of the offering. So where we are looking at providing a service where the PUDO point is simply receiving and handing off, or receiving and handing off a package, the rates are going to be in the low dollars numbers, sometimes less than $1. And then we will pay the PUDO points a per package fee for transacting that. On the return side, it largely depends on what the service is. There are instances where we get the returns packages to our facility and they're sorted in Toronto, and then a retailer or customer will come to our facility and pick them up, and they'll take over the shipment from there. There are other cases where we're sending that merchandise to Hong Kong or to the UK. So those can be, tens of dollars as far as getting packages back to where they need to be. But as I said, on average, the gross margin of the business is 35%. The returns business is less than that. The pickup business is more than that. So I do anticipate that margin as we are focusing on growing the returns business. I do anticipate our overall gross margin will trend down. But nonetheless, it'll stay very healthy, and we'll see very good revenue and gross profit growth.
Now, Elliott, earlier mentioned you've spent some time cleaning up the balance sheet. Now, looking forward, do you guys have the resources you need right now to sort of execute your business plan as you have? Or are you guys looking for more capital or any other resources you need?
Look, more is always better. As I mentioned, we are profitable, so that puts us in a very nice position. I certainly could spend money, and I would be spending money on marketing and really adding new customers and adding new PUDO points. So if we had more money, that's the first place I would spend those dollars. We have a pretty lean team. So in order to continue growing the business, we need to beef up our staff. And that's across the board. That would be in sales and marketing, that would be in operations, that would be in accounting. So we will have a need to support more people. And then IT is an area where we would definitely benefit from more cash to be able to expedite our implementations. We don't really have big IT development spend. Like we don't sit around and say we need to go develop and create a lot of software or anything like that. Where I wish we had more resources is in a bigger team that can integrate new customers and new opportunities faster.
Maybe you've answered this question, but what sort of keeps you up at night? What's the biggest challenge faced by the business right now?
The biggest challenge is it's just, somebody coming out of left field and doing what we do. I really hope Amazon never decides to start handling other people's returns. That would be, that would not be a good thing for us. But aside from that, there's not really a lot that I worry about from a risk perspective. What I really worry about and what I spend a lot of my time focused on is how do I grow this network and how do we add more customers?
Standard stuff. Good. 33 million shares outstanding. Roughly how much is held by insiders, and maybe any idea of other sort of what does the shareholder base kind of look like?
Our shareholder base is, and this is a really good question. I'm glad you asked this question, Paul. Our shareholder base right now is probably around 50% insiders. And that came largely from some of the initial investors in the company. The company kind of ended up in a roundabout way becoming public through a reverse merger through a company called Grandview Gold, which was owned by some of the larger investors who, when they were contributing their capital to PUDO, they decided to do it through the public vehicle of Grandview Gold. And a lot of our shareholders have been with the company for quite a while. I would say that this has been a long road for many of our shareholders. The company started in 2015. I think when people really kind of got involved in force 6 or 7 years ago, they expected this to materialize a lot faster than it has. And we have a number of shareholders who are in their 80s. And I know that a lot of them would love to get out of their positions. Sadly, we've had a couple of them pass away, and now they're with their families, and their families don't really want the shares. So I think there's a good opportunity, and I would really like to see it, and hopefully this call will help advance this. We would really love to see some turnover in our shareholder base and get some fresh names in the company. And I do think we have a circumstance where people are willing to sell, not necessarily because they don't like the story or the investment, but frankly because they don't know it, and they don't want it, and they don't need it.
Yeah. Very, very typical of the microcap space here in Canada. Not unusual at all. I always like to ask this question, and it gives us a sense of kind of mind frame, but new initiatives. I mean, we clearly doing more of the same thing is kind of big part of your business, but is there anything outside that we haven't really spoken about that you're seeing as opportunity? For example, like, do you ever look at Europe to do something like this, or or is there another sideline business that you can tap in? What kind of new initiatives are you looking at?
We don't, nothing that is really outside of what we're currently doing. I think that one of the quote new initiatives, and again, it's not really even a new initiative. It's just one of the things that we've seen is increasing interest in our network to be used to facilitate shopper pickup. So, and again, it kind of goes back to what I was mentioning earlier about how retailers are incentivizing shoppers to forego the doorstep delivery, and they're incentivizing them to go someplace to pick up their package. So what we have seen recently is increased interest and increased conversations with retailers about being able to use our network to deliver that. But at this point, we're not looking geographically to go anyplace else. We're not looking at adding any other service lines. Honestly, I think, we probably would rationalize some service lines. Some of the things we're seeing some lower growth and less importance, but at this point, everything is profitable. And given our small size, I'm very reticent to remove service lines because they don't really require a lot of investment, and they're generating cash. So no, I think the interest is shifting a little bit on behalf of our customers as far as what their emphasis is for our services, but we're not in the process of developing or expanding in markets where we don't currently participate.
Fantastic. Okay, great. Well, listen, I'm kind of done with my questions for the most part, but we've got a handful that have come in. So why don't we tackle those questions right now? I got a question from Hassan. It says, as a small player, how do you manage and maintain your relationships with your partners/customers?
We try to spend a lot of time in front of them. And it is interesting because a lot of times what we find with some of our larger customers is that it's almost like they're a lighthouse, and their attention is shifting around the globe, and we won't have much communication with them. We won't have much communication with them, but all of a sudden that light will hit Canada or the United States, and we'll just get barraged. And so when that happens, we capitalize on it. We go sit down with them. We try to think, through what their challenges may be. We try to, again, present very customized solutions to them. But we do very actively drip on our customers and try to stay in front of our customers. Some of them are very responsive and very, very engaging. Most of them, I would say, like I said, it's more like the lighthouse, that when their attention circles around us, then we get the attention and we have those conversations.
Gotcha. Okay, Scott asks, external processing charges appear to be impacting your gross margins year over year. What are your expectations for these expenses moving forward?
I'm not sure I understand what that's referencing as far as external processing charges. So maybe we get some clarification on that.
Scott, if you can give some more details on what you mean by that question, we'll sort of we'll re-ask it here.
I think maybe to maybe address that a little bit is, with the shift of business mix, where returns is the fastest growing component of the business. As I mentioned, that's a lower margin component of the business. And so there are more costs, and there are more cost components in that business. Knock on wood, we have not really seen pricing pressure from our vendors. And again, like I said, knock on wood, I'm sure next week that'll change now that I've said that. But we've been able to maintain our cost structure fairly well over the last several years.
Okay. Okay, so Scott also asks, how are you retaining business you might have picked up during the Canada Post strike?
You know, we did, and I really hope they go on strike again.
Yeah.
The the way, the way that we've retained it is by connecting with these customers and understanding their needs. And I think the Canada Post strike was a bit of a wake-up call. And obviously, given there's still a risk with Canada Post, a lot of that business has stayed with us. And I think people are enjoying what once people make the transition, that's kind of the most painful part, is onboarding a new vendor. And so one of the things that we see is once they go through that exercise of getting integrated and getting everything activated and getting us in the logistics flow, they don't really want to shut that down. They like having that option. Now they may decide to cut back and push more in back to Canada Post, and oftentimes what will drive that is a customer needing to have certain volume levels with Canada Post to get a certain rate structure. So we'll see some shifting potentially from that. But like I said, once people have gone through the effort of onboarding and activating us, we don't see them necessarily disappear.
Gotcha. Okay, next question comes in from Justin. He asks, if a large logistics player wanted to replicate your model from scratch, what would be the hardest part?
Building the network, building the PUDO points.
Yeah.
We are a non-asset-based company, so we don't have trucks, we don't operate any of our own warehouses, we don't have any proprietary PUDO points. But the network is the hardest thing to replicate by far.
Yeah. Clearly, it would take time and a lot of effort, and obviously a lot of cost to build those relationships and replace that. Okay, so how do you think about pricing power? Could your customers push prices down for you and you're stuck paying the PUDO point a fixed amount per package?
So read that last part again. Just read the question.
Yeah, okay. So how do you think about pricing power? Could your customers push prices down for you and then you're stuck with paying the PUDO point a fixed amount per package? Like would a customer like I don't know, a retailer, do they have the ability to sort of push pricing down for you while you have a fixed cost with your PUDO points?
That can happen. And in fact, it does happen with Amazon. So Amazon, they don't necessarily tell us how much we need to pay to the PUDO points, but they do mandate a certain percentage of what we get goes to the PUDO point. We do operate in large part on a fixed per package cost basis with our PUDO points. And as we onboard new customers, our customers don't really know what that price is. They have a pretty good idea. I mean, it's the pricing in the market is not, it does kind of coalesce, but they don't necessarily dictate what we're going to pay to the PUDO point. They certainly negotiate with us and say, I want to pay less. And then that just becomes kind of a normal, negotiation where, we look at the volumes and we look at the relationship and we, enter into a commercial arrangement based on that. But one of the things that's good to keep in mind is our cost structure is both variable, and it's also very efficient. So we are often able to offer our customers pricing that is better than what they're getting from the large courier companies, just because our cost structure in processing the business is lower.
Gotcha. Awesome. Okay, another question from Justin. He says, how do your customers measure ROI when they use your service? How sticky is their usage?
It's very sticky. In fact, I would say the majority of our customers, we're seeing increasing share of wallet. So it is very sticky. How they view ROI, because a lot of this is returns, what they are trying to do is get refunds back to customers in a timely basis. So what they're trying to manage is keeping the cost of the return as low as possible. And it's interesting when you think when you use the term ROI, because this is a complete cost center for these people. There is no profit to the retailers associated with returns. I mean, it's a very difficult thing for them, because if you think about the way this impacts the retailer, they're losing revenue, right? So they've sold a product.
Yeah.
They've recorded that revenue. So they now have to back out that revenue, and then they have to pay to get it back. So they don't necessarily talk to us about ROI. What they talk to us about is price and transit times. And one of the nice things about reverse logistics returns is people aren't really in a rush to get this back. Like it's not like outbound logistics where people are trying to get merchandise on the floor in time for Christmas or in time for Easter, or where you have deadlines and things need to be available to the consumer by a specific date for a specific seasonal window. There's a lot more flexibility on the reverse side of this process, where the retailers are trying to figure out the most cost-effective way to re-commerce this merchandise. So transit times and cost are really what we have most of our conversations with our customers around.
Yeah. Okay, Gilles asks, for fiscal year 2025, PUDO had roughly 900 PUDO points in Canada and revenue of just shy of $4 million. And in the US, PUDO had 850, give or take, PUDO points and revenue of only 156,000.
No, sorry.
Does that make sense?
Yeah, let me just, yes, it does. And this is it's fine. I had this conversation with our auditors and it was maddening. The US revenue is not US revenue.
Okay.
I'll see if I can get you a US revenue number here in a minute. That US revenue is our US entity.
Okay.
So so we have some pretty big NOLs in Canada. So whenever we can, we try to put U.S. business into the Canadian entity, but it gets reported. But when you look at our financials, it shows up as
I
Canada
gotcha.
and not the
Yeah.
U.S. So
I think, yeah, that explains it very, very quickly. Yeah. Um, well, it sort of makes the last part of the question moot. What will it take for the US PUDO points to generate as much revenue as the Canadian PUDO points? My guess is that subject to some maybe local economics, the metrics or the cost on a unit basis can't be that much different from Canada to the US.
no, but it is a fair question, and it
Mm,
does again circle back to what I mentioned earlier about the the PUDO points in the United States, that not all of them handle returns. Every location that we have in Canada is effectively full service. It is pickup and it is drop off. So
mm,
it's pickup and it is returns. So those locations are generating revenue from the full suite of services. The
mm,
US locations are not. Again, we've got Boston, New York, New Jersey, and Miami that are
mm,
processing returns. And in order to kind of increase that revenue growth in those, one of the biggest things we have to do is get those locations handling returns.
mm, mm. Um, Following question there is, what is the US revenue? Can you give us a sense of how much is
Yeah,
truly Canada and US?
give me 1 second.
Sure, sure, sure.
Let me see if I can make sure I don't start
Mhm.
broadcasting something I shouldn't be broadcasting here. I thought I was going to have that readily available. Um, I'm going to need to get back to you on that, but today it's the U.S. today is roughly 15% of the business, the revenue. So I don't have the
Gotcha.
exact revenue number for you, but the US is about 15% of the
Yeah,
revenue.
okay, perfect. I think that's good enough. Um, okay, now Scott's come back with Scott was the guy that asked a question about the uh how do you call it? Processing charges. He says external processing charges is note 12 in the financials, 2.7 million in 2025 and 1.95 million in 2024. Does that help in any way in terms of
Yeah,
where that could be?
that's what we pay our dealers. That's
Okay.
what we pay our PUDO points.
Gotcha. So that's just basically, yeah, that's volume based. The more obviously, the more business and the more PUDO points, the higher that number's going to go. Okay, so Russell asks that do you offer or have you considered a volume discount like Canada Post does?
We, as much as possible, we try to provide tiered pricing.
Hmm.
And as everyone, will be shocked to hear, it is not uncommon for someone to come to us and say, we're going to give you 20,000 packages a month and
Hmm.
have 5,000 show up.
Hmm.
So when we compete for business, we compete, like I said, clearly, largely on price.
Hmm.
Um, but we also don't want to be, offering a service for a 20,000 package level and only have 5,000 show up.
Hmm. Hmm.
So we avoid that by trying to provide tiered pricing, especially for our new customers. Now, for our existing customers where we've got visibility and we know what's happening, if there are pricing discussions with them, then then those will often be at a specific rate. And we're not dealing with the tiers because we know what the volume looks like.
Mm-hmm. Gotcha. Okay, so Jill's asks, can you talk about your relationship with Purelator? Is Purelator one of your larger clients?
Purelator is one of our larger clients, and they use us largely for the failed first attempt, where they again, the failed first attempt, just to remind everybody, is where Purelator will go. They have a package out for delivery. The consignee is not available, and then they will come and they will drop it at one of our locations for subsequent collection by that person.
Mm-hmm. Gotcha. What Justin asked, what is your projected gross margin? Is it safe to assume it will drop a bit as the US locations add return service, but you'll earn more revenue per location? Is that the way to look at it?
Yep,
Yeah.
that's exactly right. I think we're there are some very significant potential customers that we're talking to that would have margins in the mid to high 20s.
Mm-hmm.
I don't really see us going below that to try to win business. So that could put pressure on the margins. But again, we're talking about pretty sizable revenue numbers.
Mm-hmm. Gotcha. So we mentioned Purelator earlier. Any other couriers you're working with? And if not, like that seems like a pretty sizable market to go after.
Yes. So we really work with everybody who's active in
Mm-hmm.
Canada.
Mm-hmm.
In the US, we don't work with the couriers as much. And the couriers in the United States, they've become more focused on using a lot of their proprietary locations. And then the other in the United States, we also work with a lot of parcel stores.
Mm-hmm.
And those parcel stores will often have relationships with the couriers themselves.
Mm-hmm.
So they don't necessarily need us in the
Mm-hmm.
mix to be able to do that. But in our non-parcel stores, we don't work with the couriers in the United States. And that certainly is an opportunity for us. But in Canada, we do work with pretty much all the major couriers.
Mm-hmm. Mm-hmm. Um, Elliott, where do you see this business in 5 years? Kind of, is there an end game here that you have in mind?
I mean, I think we would be a really good fit for a 3PL. I think we could be a really good fit for a SaaS provider that decides they want to control their own network. I think those are the two. I think those are the two most likely in-game scenarios for the company. But aside from continuing to do what we're doing and growing the business, keeping on keeping on. As I said, it's very interesting to me, the interest that we get from some very sizable players just because of the network. And those players don't want to go through the brain damage of building, managing, servicing the network.
Yeah, that makes sense. Um, the As you guys see more profit, as you guys see more cash flow, is it safe to assume that you'd mentioned if you had more cash, you're going to spend it on marketing? Is that really the way to look at it? Any excess capital now is going to go back into sort of more of the same?
Yes.
Mm-hmm.
Yes.
Okay.
Yeah.
Okay.
Yeah. If I had a bunch of extra cash right now,
Mm-hmm.
it would be marketing,
Mm-hmm.
and it would be staffing to
Mm-hmm.
do what we're currently doing faster.
Hmm. Hmm. Gotcha. Okay, so I'm going to take one more question from the audience here, then we'll get ready to wrap up. But Justin says, "What's the biggest thing the market misunderstands about your company? Stocks being down, but revenues, profits are trending positive. What do you think the market doesn't quite get yet?"
I, I, you know, I would like to put that question back out to the audience. Um, but in fairness, and I think probably the more legitimate answer is, as I mentioned, I came on about 2.5 years ago,
Mhm.
and what I stepped into was different than what I thought I was stepping into.
Mhm.
And there was a fair amount of retooling and reorientation that we had to go through that um, that I really it took me a while to get my head around it. It took me a while to do it.
Mhm.
Um, and I was not communicative with the investing community during that time because we really didn't know which way this company was going to go.
Mhm.
And there were certainly some challenging times, and there were, we were burning cash, and it was really difficult to know what to say to the investor community because we were effectively retooling.
Mhm.
Um, that's changed. We're through that.
Mhm. Mhm.
I don't want to say that everything, works 100%. We still have challenges. We still have issues.
Mhm.
Things still break. But I am much more. This job is a lot more fun than it was 12 months ago.
Mhm.
So I think probably the biggest miss is me not being more communicative with the investor community.
Mhm. Well, you came on here, so that's a sign that things are changing. Elliot, as us investors are paying attention to the business, where do you think we should focus? What sort of metrics or maybe catalysts should we pay the most attention to?
Well, I'll tell you what I pay attention to.
Hmm.
I pay attention to network development.
Hmm.
I pay attention to revenue growth, and I pay attention to gross margins. And so the things that I really watch, and y'all don't necessarily have, obviously you're not going to be getting per customer volumes, but
Hmm.
my regimen is what is happening with our per customer volumes
Hmm.
and then subsequently revenue. So revenue is obviously the metric there. Um, how are the gross margins doing?
Hmm.
There's not a lot of fluctuation in our operating costs. The
Hmm.
fluctuation that you'll see in the operating cost will come as we add sales and marketing efforts and as we add to the payroll. Um, but we're judicious about how we do that. Um, and then as I said, where are you seeing more PUDO points?
Hmm. Uh, um, this has been great. Hey, did we not ask something we should have asked? Or if we covered everything, what do you want to make sure everybody walks away with as far as the key message?
Well, look, I'd love to go back to the question as to why the stock isn't moving.
Mm.
And again, I'm not surprised by it because we have not been out in front of the investment community. Um, but I would, really love to see, like I said, people, getting into the name. One of the things I'd love to see is, even small positions.
Mhm.
Like I said, there are a lot of people that are long in the tooth in this investment, and they would like to have a way to get out of their positions. So I think the opportunity is there is to pick up some shares. Um, And one of the things that we really would like to see is more volume in the stock.
Hmm. Hmm. Well, perfect. Well, certainly, as a group, we're always interested if you're aware of any blocks or anything like that that might come up for sale. We'd love the phone call. We've been speaking with Elliott Etheredge, CEO of PUDO Incorporated. This time I'll get the symbol right. The symbol is PDO on the CSE and PDPTF on the OTCQB. Elliott, this is the first chance we really got to highlight the company, so I'm happy that we got that chance today, and we certainly look forward to keeping up to date and catching up with you in the future.
Great. Well, again, I really appreciate y'all coordinating this, and look forward to hopefully seeing some shares trade.
Absolutely, absolutely. Thanks again, Elliott. We'll catch up soon. Bye
All
for
right, y'all
now.
have a great weekend.
Bye now.